Now we're going to turn to Asia. And before we get into it, we'd like to ask you to comment on things that you want to hear more about within Asia in general, just because there's a lot to cover. There's a lot of geopolitical things happening. And we try to link it back to what does it mean for the U.S.? What does it mean for just relations in general? And really, what does it mean for trade? Because we follow trade very closely, and that's why we were concerned on exports before they became an issue in China, before the data started to slow. And you started to see that because we're trying to look ahead of what are some of the impacts that we're going to see. So, Myanmar or Burma has been in the news significantly. Now, it's important to appreciate what happened. So Suu Kyi's National League for Democracy, her party, she's been in power for essentially since I think it's 2011 at this point. And this was after she was under house arrest when the military was in charge. Then she won and she worked out a deal with the army in general. So now she was brought before the under the Geneva Convention for war crimes that were discussed for the Rohingya ethnic group, which is a Muslim group, which is right here on the corner. Now, they have been systematically killing a significant amount of people in these villages in terms of, and this has been supported by Buddhist monks as well as the military, and just raising villages, using horrible torture tactics. And she was very saying, nope, there's no issue. And she was brought before 3 or 4 different times where she was asked, is there something happening? Now, her group, the League for Democracy, and the military, even though they hate each other, they could agree upon that they both didn't like this specific ethnic group that this picture shows. So you can, it's sad because again, an enemy of my enemy is my friend until you're my enemy again. And now that there has been a significant amount of this ethnic group of the Rohingya group has moved into Bangladesh to get away from some of the attacks, and unfortunately, Bangladesh is now completely overwhelmed on the refugee side with their refugee camps. Now she won in the landslide, and because of that landslide, she believes she had the right to challenge the military. You can try to challenge the military, but again, that you will fail, especially in Myanmar's setup. So what does that mean? That means that her and her party members were put under house arrest. They have declared a 1-year lockdown and a military coup, and the military is now going to take over. But there were also other issues of why would they do this now? And it's because there is a significant amount of pressure in that market specifically because there are other areas that have raised militias. So let's just talk about. So the Kachin Independence Army and the Shan State have all have their own military now. There are several militaries that have been, or the Kachin Independence Army, they want to be their own separate entity from Myanmar. So the military could have said, look, you wanted a landslide, you think you're going to take control. We're going to take control because we need the ability to protect ourselves and to keep a cohesive component. So China's not going to say anything because China has the China-Myanmar economic corridor. Why is that so important? Because going through Myanmar means that they get to avoid the Strait of Malacca, and they have another exit for goods and services and other things coming through Myanmar away from a choke point that Vietnam, U.S., Philippines, Japan all practice closing and creating a blockade. So this is why, even though there should be, and not that China would, but there should be something said about what is happening in Myanmar, that's not going to change anytime soon. Now, we think that there's going to be additional strife as other entities within Myanmar look at this as a means of attack on them, and they will turn around and try to maybe be a bit more preemptive. Again, this is going to be something to watch because this is very important to China's way of getting around some of the logistical hurdles that we've seen in the market. And again, things that have to be that we try to pay attention to build a overarching theme of things that are happening in the world today. Now let's take that to the next level and let's look at what's happening along the Indian and Chinese border. So China has been ramping up its military infrastructure, as we continue to talk about. Now, this is just a breakdown of additional heliport construction that we've seen in areas right along the Himalayas. Now, this is going to allow for more communication because you're going to be able to move things back and forth. India is not sitting still. They are also hardening their own capacity. They will be having a squadron of French Rafale fighter jets at that area, which is why they're hardening the facilities. So again, it's happening on both sides, and it's becoming it's becoming a very important flashpoint. And the reason why is because 50% of the world, and I thought this was a great chart, 50% of the world lives along these levels. So let's just look at where we're talking about. So obviously there's these dots in China, there's the dots in the US, in Europe, parts of Africa, but just look how along the Himalayas, that whole area is lit up like a Christmas tree. So we have these friction points that are occurring at an area where a significant amount of the world population actually resides. So when you think about China and India coming to blows, you're talking about almost 3 billion people in the world going against each other. And that's why we look at this so much, because this is going to have a reverberating effect throughout the supply chain, the global economy. This is going to be something to watch, where who takes whose side? Where do we see the shift? So we know Russia has taken India's side. We know the U.S. is more on the India side versus the Chinese side. We know, and that's through Australia, through Japan, the agreements that have been made. This is going to be something to watch as the events unfold, and as Biden's administration doubles down on, coming at the Chinese government, coming at the Chinese regime, and what they're doing to not only their people within the country, but also how they're interacting with other areas around them. So, but first, before we get further into China, let's talk about India. So India high-frequency dashboard, new COVID cases, again, starting to come up a little bit, but way down from where it was in October, December through December. So still in the positive. Total active cases ticked up a little bit, but again, nothing crazy. Vaccine administered, starting to go higher. The lockdown index is actually going to start to roll back. We're starting to see some movements that are increasing. So in the next iteration, the next time we show this, the lockdown index will be lower. It won't be 69. It will be something closer to the high 50s, most likely high 50s at this point. The unemployment rate is ticked up a little bit, but still positive. Consumer sentiment remains a problem, but again, where isn't that the case? So here you're starting to see retail, recreation, some bright spots. But as we talked about in the EIA show, diesel demand is still down, gasoline demand is still down. So we're still seeing some friction points in terms of where are we going to get this movement. And so, where can they get this movement? Well, let's look at inflation. So inflation dropped, or is expected to drop, to RBI's, their central bank, the 4% target in the second half of fiscal 2022. But it has fallen far enough within their range. So if you look at CPI inflation, it's now within the range. And that means that they feel as though, and they've obviously clearly tried to stimulate the economy, and if you look at the budget, which we'll touch on in a second, they're going to increase the amount of spending and borrowing in order to try to incentivize just recovery, which is going to be a net positive for some of these high frequency data points, and is going to be a positive movement for some of the econ underlying. Now, the one area, because you can't give everything to everyone, some of those rural output trackers have gotten a bit worse as money has been redirected. Now, it's still elevated. You can still see it's where it was pre-COVID, but they've stimulated enough. Now they're going to take some of that money back and push it into other regions to try to help bring up some of that growth, especially the Indian banks, where we're seeing a big increase in bad debt expense, and there's concern about how much bad debt is on the sheets, and if they have to make a bad debt bank, if you will, to try to manage some of that risk and to provide certain liquidity and essentially protect some of the other banks and the financial system within India. So let's look at the road to recovery. So India's economy is seen rebounding, obviously the GDP growth. This is where we think there's going to be a bit more risk to how quickly we can get that turnaround. That is a comment not so much about India itself, but about exports and the general economy around it. So India still has a restriction on a significant amount of Chinese apps. I think we're up to 59 now. That's going to go higher. The strife is increasing there in general. So again, it's just going to be a matter of how many imports, exports are we going to see? And I think that's going to be a headwind, while the consumer is going to be a tailwind for India in general. So again, both of those are going to be a matter of which is better, which is worse, and that'll kind of dictate what this growth can really achieve. So now when we look at how is this going to be achieved? So fueled by bigger than expected spending deficits and borrowing, as well as sales of government assets and dividends from state firms, the 35 trillion rupee or 480 billion budget sent bonds tumbling, stocks rallying, obviously because bonds, you're going to have to go to the bond market. Who doesn't love printing more than equities? So here's that kind of bifurcation. Now, it also aims to bolster the nation's financial stability, including setting up a company to manage growing piles of bad loans. So again, making that bad debt bank, if you will. And the new budget also comes as the nation's financial sector faces increasing pressure from expected record level of bad debt. This year is escalating border tensions with China and widespread anger from farmers whose protests against market reforms overwhelmed parts of the capital. What that was, they took their farm equipment and drove it to New Delhi in a form of protest. Again, coming to that pullback on rural spending. Farmers feel as though they've been left behind. This is some internal strife that we continue to see between India and within India underlying. But again, net, there's going to be more stimulus, more money pushed in, and a separation of those and that bad debt expense. So when you look at pandemic stress, this is where we're talking about with the Indian bank's sour debt ratio is set to rise to 13.5% by September of 2021. So they're looking to funnel out some of those bad loans into another bank to protect the current balance sheets and to try to package it in general and then try to manage it, sell it off in pieces, and just do some fundraising around that as well. So then when we look at, cash-strapped government has struggled to support state banks. This is what we're talking about with capital infusion. So infuse the banks with money, pull out some of their risk, and then that will help adjust some of those leverage ratios, making it a bit stronger going forward. But even with a lot of this pressure, again, India's oil demand was hit in general with down about 10%. This is not something that is going to just adjust instantly. This is something that's going to take time, and that's why we look at diesel first and then gasoline, because diesel is going to be the biggest driver of how is the economic recovery, and then how is the consumer doing? So the gasoline move shows the consumer is getting better, but on the industrial side, that's where we continue to see some weakness, and that's related to industrial production going into, again, the export-import market. So now let's just look at Asia manufacturing PMIs, because everyone is, not everyone's held equal. So Taiwan continues to crush it. The movement is going extensively. Now, Taiwan has been asked by everybody to increase the amount of production of semiconductors. So they're going to continue to see the benefits. China has been, why did that happen? Well, we had a big increase in demand from cell phones. Car manufacturing increased exponentially, which is why the snapback on durable goods. These are things that are just creating this net shortfall. Australia is waking up from the fact that they have no COVID cases. South Korea is seeing some normalization. That's something that's going to continue to be essentially flattish in this level. We don't see it increasing to Taiwanese levels. But again, South Korea has some data points that are strong that we'll talk about in a second. China is the one that has seen some of those slowdowns if you look between December and January, as we talked about when the numbers came out last month, that we didn't see the continuation, that we actually saw the numbers getting a bit worse. And here's that numbers coming through. Vietnam is going to continue to remain in this slight expansionary territory. The Chinese official numbers, again, worsening. Japan is slightly more negative than previous. And Thailand, Malaysia are falling under the same problems that we've seen with COVID increases. And again, Japan, South Korea are those issues, with Japan, I think, getting a bit worse over time as they struggle to kind of right the ship in general. So let's just look at what is happening in investment land. So where is the money flowing? So when we look at Chinese debt, Chinese equity, and then emerging markets in general, you've seen an increase and this movement into Chinese debt as well and Chinese and emerging market debt. Now, when we look at net capital flows to emerging markets, again, you're seeing this movement out of China. And this is where we're starting to see some of this friction where companies or foreign investment or foreign direct investment, FDI, which is an important piece of Chinese growth story, we're seeing more money leaving China and going into other regions, specifically Vietnam, in India, other areas of investment to get away from the Chinese supply chain. And again, some of the changes that we're seeing in China that aren't really for the better. But with that being said, there's still a pent-up demand for debt on the Chinese level and the emerging market level, which, right or wrong, people are looking for yield, and they're finding yield in these emerging markets. China, we've talked about how you won't know what your coverage ratio is even when they go bankrupt. And again, there's a lot of fear within that different construct. So then when we look at South Korea, this is where we're seeing some of that growth. So look at industrial production. Industrial production year over year was expected to be down 0.6%, was up 3.4. Industrial production month over month expected to be up 0.8, was up 3.7. Those are net positives on the industrial production side. Now, exports surprised to the upside. They were at 11.4% versus an expected 9.8. But more importantly, and I can't stress this enough, imports year over year. So imports were expected to be 2.4%. They were up 3.1%. Still not on the same ratio it needs to be to close that export gap. But again, you're seeing that movement where some of the local consumer consumption is continuing. They're seeing a bit more movement of raw materials that is going to lead to a stable increase in exports, which is why South Korea continues to be a fairly bright spot in comparison to other areas. And if I had a choice, I would choose South Korea over Japan just based on where things sit. And I would consider Vietnam or Taiwan over South Korea. And we can talk about some Taiwanese risks that can come in when we go further into the China-Taiwan backdrop. So South Korea, the GDP by components, you can see private consumption was a net negative, but we do have that private fixed investment. That's going to remain strong. Net exports will remain stable. So they need to see that private consumption start to go up. It'll still be negative, but it'll just be less negative. And you're going to continue to see the fixed investment as companies look to continue to divest themselves or create some redundancy against the Chinese supply chain. So now when we look at the manufacturing PMI on new export orders, this is looking at China. So when we look at Chinese new export orders, we are in contractionary territory. This is in a negative 47. So we've seen new export orders come down below where things were expected. And again, this is the leading indicator. We said it before with the supply recovery versus demand recovery. We've shown it with the issues that we're seeing, all the problems within the supply chain. Now that you have all of these bottlenecks where a lot of companies already know that their stuff is available, it's just off the coast of LA or Rotterdam, and they're waiting for it to come through. They don't need to place new export orders, or they can create new export orders in Thailand, in Vietnam, in Japan, in India, away from China. Again, taking some of the market share away from China, which if you think about inflation, they've already experienced their fair share and they're going to have to push through pricing. which is why credit impulses turn negative. So when we look at aggregate financing, China credit impulses, as we showed with Shibor, you had a big push to the upside as they tried to take money out of the system. There was a shock to rates, which means that they had to push more money back in. The PBOC couldn't take out as much as they wanted, but there's two sides to that. There's seasonal because they push more money in so that for Lunar New Year, because people go and take cash out before they go travel, but they took too much and there was that shock to the system. And not that it was a huge shock as it went up, about 200 basis points, but it was enough to cause the PBOC to have a reaction. And the China credit impulses are turning negative. You have aggregate financing starting to turn down. Again, this is going to weigh on GDP. This is just showing you that they're going to be unable to subsidize exports given those price increases, which again is going to be a bigger issue on the Chinese economic recovery. So then when we look at the composite PMI, so let's break down the PMI. So manufacturing was expected at 51.6, came in at 51.3. Non-manufacturing was supposed to be at 55, came in at 52.4. Then the Caxton, again, all missing to the downside, still expansionary, but getting worse. And then the underlying components that make up this number are actually indicating a leading side that they're only going to get further contractionary based on new orders, production, and exports in general. So that's why when we think about what are some of the commentaries coming out of the government in general. So the All China Federation of Industry and Commerce, the ACFIC, Xi had some instructions for them. So this is what he said, a quote from him. The AFCIC must focus on promoting the healthy development of the non-public economy and strengthen its political leadership and ideological guidance. Now, ideological guidance, what does that mean for a communist country? Well, Trivium has an answer. The AFCIC needs to make sure that private companies are serving the national interest. Xi wants private companies to know that they thrive at the pleasure of the party, which just means that think about Jack Ma, think about Alibaba, think about all of these things that have happened. Xi's China, the line between private business and the party is increasingly blurred. And again, we're seeing, as we talked about in previous shows, China is increasing the amount of party members by percentage of employees at private entities. This is going to continue to happen, pulling those private entities back into and underneath the communist umbrella. We've already had him say that he believes that party members and party executives do a better job than private entrepreneurs. Again, these are things that are going to continue to struggle, and that's going to lead to pressure on PMI. That's going to mitigate some foreign direct investment. Do I want to worry about what are they going to make me do if I'm trying to invest in their economy? If I'm an entrepreneur in China, am I going to invest in China or am I going to try to invest somewhere else? Knowing that these things are happening. So then when we look at semiconductors, again, remember that Huawei was trying to build an inventory in case China, the U.S. increased and ratcheted up their sanctions, and that's why we had integrated circuits as the huge increase of imports. Now, this is something that is going to be stored, which means that they're going to import less over the near term, but you can also see that crude oil demand has fallen. And again, this is where we continue to see that the crude in general and just integrated circuits, which when we in our show Chinese Communism Rising, we talked about Xi's focus on the dual circulation strategy and building out a much more robust technological innovation, technological sector, and manufacturing, and this is clearly a huge part of it. So this is not going to stop, and is another reason why Taiwan, with so much semiconductor capacity, so much ability to just make and create circuitry, motherboards, they become a strategic importance for China in general. So let's look at, again, the service PMI. So services is coming further down. Output is slowing down. The services is where we continue to see the problem because, again, the consumer remains a problem within China. Supply recovery, demand recovery. Supply is slowing. The demand was never there. So that's why we continue to see this struggle. So when we think of the Caxton January PMI at 51.3 and the official, so the Caxton survey showed that firms signaled notable weaker growth in output and total new work, with the sub-index for output hitting the lowest since April and the one for new orders the lowest since June. Part of the slowdown was from a renewed drop in new export orders, down for the first time in 6 months. Manufacturing employment also fell. Manufacturers maintained a positive outlook for the next 12 months, but there are concerns over the sustainability of the recovery. Again, supply, demand, which remains the overarching problem. So then when we look at external demand hitting a low, this is, again, looking at the new export orders are coming down based on that 50 index. And then so you're coming back into a contractionary level as you see the Chinese exports year over year starting to tip down. So that means that again, as we've been saying, their export numbers are going to disappoint to the downside because they're seeing more and more pressure. Now, this is also structural. There's not as many TEUs or containers. The cost is going up. So you're seeing this struggle back and forth that is just weighing on general activity that is going to hit China directly. So Yang gave an address via video link to the National Committee on U.S.-China Relations. So this is where we're going to start talking about Taiwan. So Yang also had a warning. He told the U.S. not to cross China's red lines in Taiwan, Hong Kong, Tibet, and Xinjiang. Any trespassing would end up undermining China-U.S. relations and the United States' own interests. The downturn in U.S.-China relations is structural. It was not... and I've said this many times, and I said this again in the May 29th show in the comments, and I'll post it again in these comments. We were on this road. This is not something that Trump created. This is not something that Obama created. This is not anything. The pivot to Asia was always going to happen. The trajectory was set at Tiananmen Square. There were things that were already moving in this trajectory, which is going to, again, hurt export orders because guys are moving away from China. They're moving away from it, especially as you have the Biden administration holding firm on their call of genocide within in Xinjiang. That way, if you look at what that means that they're going to have to do something in terms of sanctions. You look at Taiwan. China has been running. They flew more fighter jets and bombers over the Taiwanese Strait. What did we do? We sent an aircraft carrier fleet through the Taiwanese Strait. There's going to continue to be strife, and you might say, well, China's just doing that. What does it matter? Well, every time China runs one of these exercises, they do it from a different angle. And the goal is, 1, reaction time. 2, what type of equipment are you responding with? And this is going to help them prepare for a potential invasion. Not to say one happens, but this provides them the ability to come up with some means of addressing it. So when we look at it now, earlier this week, India reaffirmed its June decision to permanently ban 59 Chinese apps from its online ecosystem. Again, it's not just the US, it's not just others. When we think about the export data, it's also India. It's also other trade partners that are becoming a bigger problem and is going to put additional strain on the Chinese economy. So now Xi is putting the communists back in the Communist Party. Now, what does that mean given where the shift is going? So these are 3 of his quotes. In order to fully implement the new development concept, it is necessary to pay more attention to the issue of common prosperity. Again, dual circulation strategy, increasing local consumption, but taking it from people who are wealthy. Again, redistribution is becoming a bigger part of the underpinning of giving more money to buy more stuff. We must concisely and actively resolve regional disparities, urban, rural disparities, and income disparities. Again, regional, as we showed last week, the difference between northern GDP, provincial GDP, and southern provincial GDP, there's going to be a movement of GDP dollars from one to the other. And then obviously income disparities across different social levels. We must promote social equity and justice and make sure that the fruits of development are more equitably shared by all people. Redistribution. Deng said the party would let some get rich first. So the idea was that Deng was going to open up the China. He was going to allow people to achieve wealth in order to create an economic growth or economic prosperity. As we know that you need to incentivize people to invest and to take certain risks. Xi is saying that enough people have gotten rich and now it's time to share the wealth more broadly. Pivot back. This is why I can't stress this enough. It's a communist nation. Now, have they achieved communism? No. Have they achieved the dream or the utopia? No. But it doesn't mean that they aren't going to try at bigger levels. So this marks a major shift in how the party approaches the economy, but it is still unclear what it means in practice. So again, we've seen what the structure is at the when we did the Chinese communism rising, which we'll post again I'll post again in the comment section because these are importantly linked. These are things to watch going forward. Now, when we look at refinancing pressure, so when we talked about the shock and we talk about things that are trying to happen within China, refinancing pressures, Chinese companies abandoned more local bond sales amid cash squeeze. Again, as rates shot up, they had to take away some of this movement. Now, this is starting to adjust as rates have come down. And Chinese firms have rushed to cancel domestic bond sales after a cash squeeze in the nation's money markets pushed up borrowing costs. They shelved about 35.24 billion yuan or $5.5 billion of onshore bond sales last week, up 58% from the previous week. So you can see that as rates went up, they had to essentially cut some, or because they became more expensive, they pulled some of these bond deals. This is going to have to, which is why the PBOC is going to have to leave cash in, pull some of these in this interest rate down, which they've started to, and this will put more bonds on the market. So then when we look at, again, the issues within China in general, we have to look at food. Thailand, drought and strong baht have made the Taiwanese rice exports more expensive. We also just had something come out just now while we were filming this that so far the export numbers have disappointed to the downside. There continues to be a problem in terms of food. Now, the reason why I say this in this segment is because inflation is going to hurt the consumer. Fear of or war is going to increase because I need to feed my people and I'm going to incentivize them to find a way to eat, to find a place to find food. And again, this is what we have to continue to watch. Now, when we look at top 6 daily reported U.S. corn sales since 1977, China on January 29th and China on January 28th, 2021, China in 2020 and China in 2020, you could see that 6 of the biggest corn sales in U.S. history, or at least since 1977, has been China. USSR in 1991 was the biggest. Again, they need to feed their people and they're struggling to find places to do it. Corn sales is just the beginning of what they're looking to do. So weekly China soybean port stocks, even though they've bought a significant amount from the U.S., trying to buy more from Brazil, they're not buying it fast enough. And here you can see the stocks actually going down to levels that they haven't seen since 2020. The goal was to increase storage, so they want to be higher than this. So data from China ports suggests that they are not exactly stuffed with soybeans, even though U.S. exports to China are on a record pace. October-December shipments were down 9 million tons on the year, which at least partially explains October-December shipments from Brazil were down 9 million tons, which is at least partially explains, and we'll talk about in a second why. Now, this handle on the bottom, KANNBWX, highly recommend. Great follow. She's fantastic in terms of getting some of this data out there. This was pulled from her Twitter stream. So then when we look at approximate weekly U.S. soybean export inspections, given we're continuing to search to the upside, and it's really because China is a huge buyer trying to give their people the ability as inflation is increasing in general and they're seeing more pain on the consumer level. Again, trying to get these individuals to buy more stuff and giving them more abilities to do that, giving a cheaper amount to eat in general. So this is also looking at just the harvest. So harvest of soybeans in Mato Grosso was only 5% complete as of Friday versus 27% last year and 18% on average. Corn was only 2% planted versus 22% last year and 50% on average. So here, now, not to say you can't make this up, but we are seeing additional pressures, not only on the demand side for grains, but on the supply side for grains. This is going to continue. We've seen it now in corn, in beans, in rice. This is going to become a bigger and bigger issue as food prices and grain prices continue to push higher, which is going to hurt inflation, not just in China, not just in the US, on a global level, increasing the pain for all of those that are experiencing extreme poverty that we've talked about in multiple different shows. These are the things that are all linked together, driving oil demand, commodity demand, trade networks. The strife is real. We're sitting on a powder keg. It's just going to be a matter of what ignites it. In the meantime, rhetoric's going to get worse. Trade disputes and freedom of navigation acts will increase while the inflation at the consumer level continues to get worse on a global level. So there's a lot to talk about. Again, even though we ended on a bit of a negative note, we showed some of the positives on the manufacturing side, the services side, some of the other pieces. Again, there's a lot out there. There's a lot of friction points. So let us know what you'd like us to talk about next. We'd love to hear from you. Again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.